So something really weird just happened on Wall Street. There's this long-standing pattern, this kind of ghost that haunts traders every single year, and it looks like it might have just been broken. But is that the whole story? Or is something else going on under the surface? Let's break it all down.
Okay, to really get what just happened, let me ask you a quick question. If you had to pick just one month out of the entire year that truly makes investors nervous, the one with the absolute worst reputation, which one would it be?
Yep, it's September. For decades, this month has been just notorious for bringing chaos and, let's be honest, a lot of pain to people's portfolios. It's really earned its dreaded reputation among traders. And this right here is where our mystery really begins. Because the first week of September 2025 didn't just ignore the history books, it practically tore them up. Instead of the usual losses, the S&P 500 in the US was up over 1%, and India's Nifty 50 also had a pretty solid gain. So the big question is, why?
To understand just how unusual this is, we need to properly introduce that ghost I was talking about, the one that haunts the market. It's called the September effect.
And what's wild is that this isn't just some old Wall Street superstition or a hunch. Nope, the September effect is a real, statistically documented thing. It's this historical tendency for stocks to just perform way worse this month than any other time of the year. And the data is pretty hard to argue with. Going all the way back to 1928, the S&P 500's average return for September is negative. It's the only month with a consistently negative average. The market ends up in the green less than half the time. And this isn't just a US thing. Over in India, the Nifty 50 has fallen in 6 of the last 10 Septembers. The history is crystal clear. September is the month you're supposed to be on defense.
So how in the world did the markets defy this history? Well, our investigation starts with clue number 1, coming from the U.S. market. And it was all about a huge, high-stakes bet on the Federal Reserve.
The whole rally was driven by this strange, kind of backward idea, the bad news is good news theory. The thinking goes like this. If the economy starts looking weak, then the central bank, the Fed, is going to have to step in and cut interest rates to help out. And cheaper money is basically rocket fuel for stock prices.
And we saw this play out perfectly, step by step. First, we got a shockingly weak jobs report. Only 22,000 jobs were added. Now, what was the market's reaction? Panic? No way. It was excitement. That bad news immediately cranked up the odds of a Fed rate cut, and just the possibility of easier money sent stocks flying. Bad news literally became good news.
And just how sure were investors? Well, by the end of the week, the market was pricing in a staggering 91% chance of a rate cut at the Fed's very next meeting. Wow. In the market's eyes, this wasn't just a maybe, it was basically a done deal. And you could see this conviction in where the money was going. Cash poured into the sectors that love lower interest rates. We're talking communications, tech, and small-cap stocks. At the same time, money was flowing out of sectors that get hurt by a slowing economy, like energy and financials. This rotation, right here, it tells the whole story of the bad news is good news trade. Okay, so while the US market was sending this one very clear signal, our second clue, coming from India, tells a completely different and way more complicated story. It was a market that was basically a house divided.
So yeah, on the surface, India looked strong, just like the US. But when you lift up the hood and look at the engine, well, it was sputtering. Investors there were sending a much more complex and frankly a much more nervous signal.
Analysts saw this really fascinating barbell strategy taking shape. So picture barbell with heavy weights on both ends. On one end, you had investors making a safe bet, pouring money into defensive consumer goods. Companies that sell stuff we need no matter what. But on the other end, they were making a super risky bet with tons of cash surging into the really volatile metals sector. The message here is total uncertainty. They're playing defense and offense at the exact same time. And you can see that great divide so clearly in the data. You had incredible strength in metals and consumer durables. But at the same time, money was rushing out of the IT sector. And, this is the important part, the banking sector. Banks are like a barometer for economic health. So seeing big investors pull back from them, that's a pretty big red flag.
In fact, the weakness in the Bank Nifty, which is India's main banking index, was so bad that one analysis put it very bluntly. They said it represents a decisive and negative shift in market leadership. Listen, when the banks, the actual lifeblood of the economy, start to stumble, everyone sits up and pays attention.
So we've got these two totally different stories playing out. And that brings us to our final section, because the verdict on September is definitely not in yet, and everything could change this coming week.
Yeah, the week ahead is absolutely packed with economic data. We've got reports on small businesses, producer prices, consumer sentiment, but all eyes are on Thursday. That's the big one. That's when we get the critical CPI inflation data, the one number that could literally make or break the Fed's decision to cut interest rates.
And if last week's rally felt like we dodged a bullet, well, history has another warning for us. The data for the second week of September is also historically negative. The 10-year average returns for both the S&P 500 and the Nifty 50 are in the red. And remember that struggling Bank Nifty in India? Yeah, its historical bias is strongly bearish. So the real test might still be coming.
So, what's the big takeaway from all this? Last week's rally, it wasn't a sign of a strong, healthy economy. It was the exact opposite. It was a rally built on the fragile hope that a weak economy would force the Fed to come to the rescue. That is a foundation built on sand, not solid rock.
Which leaves us with one final critical question that every trader out there is asking right now. Did the market really manage to dodge the infamous September bullet, or is history just taking a moment to reload?